When you take your money and you invest it into a stock on the stock market, whether it's Amazon or Lululemon or Apple or Tesla or McDonald's, when you do that, you become one of the owners of this company. And when you're one of the owners of these companies, you are entitled to your share of the profits. Now, there's a couple of different ways that you can get your share of the profits. One way is you can get your share of the profits from appreciation. Appreciation means the valuation of the company goes up, which makes their stock price go up. So if you buy a share of a company for $100, this company produces bigger profits, it becomes a more attractive investment, and then the share price goes up to $200. Now you have $100 worth of appreciation that you get if you sell the company, but you only get that appreciation if you actually sell the company. If you have that $200 sitting in your stock brokerage account and you don't sell it, well, it's not actual money in your pocket, because then if that stock goes down to $50 a share, well, you just lost all of that appreciation and you lost that $50 that you invested, because now you're down. But again, you don't actually lose money until you sell. So one way that you can make money and get your share of the profits is through appreciation. So if you invest your money in a good company, this company produces more products, produces more innovation, produces bigger profits, and it's an attractive investment, you can see your share price go up. And the second way that you can make money is through dividends. If a company has big profits at the end of the year, there are three things that they can do with this money. They can take this cash and reinvest it back into the company. They can take this cash and give it away to shareholders in the form of dividends, or they can take this cash and save it for an emergency. Now, a good company and a mature company is going to do all three, and there are two ways going deeper into how do you actually give this money to a shareholder. One is through a dividend, which is a just cash check that they give you. Typically, these cash checks are given every 3 months, meaning every quarter. There are some exceptions to this. Some companies will pay every month, but most companies pay every quarter. So every 3 months, you get a check. But then there's another way that companies can also reward you by giving this money back to the shareholders, and that's by doing a share buyback. But I'll get to that a little bit later in this video. So when you're investing your money and you're getting dividends, you're investing your money for three reasons. First, you're investing your money for cash flow, because now you're getting paid without having to sell your stock, because if a company is paying out a dividend, now you're getting cash in your pocket and you don't have to sell any of your assets to get that. Second, you're getting your share of profits, because the only way that you can get a dividend is if a company pays out a profit. This is why you don't see a lot of the smaller startup and those momentum companies pay out dividends, because many of them are not profitable. They're investing so heavily in their growth that they don't want to have a profit. They want to invest every dollar that they can to get new users, to get new customers. They don't have a profit to give out to their investors, but more of the mature, older companies that have bigger profits can pay out dividends. So you get that through these dividends. And third is it's passive. Unlike real estate, where you have to own the property, you have to make sure that it's managed properly, you have to make sure you have the right team. With the stock market, you don't have to do any of that. I mean, sure, you can make voting decisions if you want to, because you own shares of a company, but if you own thousands of dollars worth of a company, or even hundreds of thousands of dollars worth of a company, your vote is pretty small. But you can vote. But your investment is very passive, because now you don't tell McDonald's what to do. You don't tell Amazon what to do. You don't have to go and flip burgers. You just get your share of the profits, and all you're really doing is monitoring your investments, meaning making sure that your company isn't going down the drain. The second thing that you want to understand about dividend investing, number 2 and number 3, I'm going to be talking about the cons of dividend investing, is the cost to a company. Now, the easiest way for me to explain this is by giving you a personal example. Now, the example that I'm going to give you is of my own company, but understand we are not a public company, but this will help you understand the cost of dividends to a company. So let's assume that my company, Market Briefs, makes $1 million worth of revenue over the year. And over the year, we also have expenses. We have to pay our writers, we have to pay our business development people, we have to pay our salaries, we have to pay our softwares. Let's assume that our costs to run the company are around $400,000 a year. This leaves a profit of around $600,000 in the bank account. Now, if this were a public company, this would then be valued and it would have a market capitalization. And to keep things super simple, I'm going to put a market capitalization of 10 times revenue, which is $10 million revenue. So the company is worth $10 million. Then you can divide that up into however many shares you want. That gives you the share price. It's generating $1 million a year. There's $600,000 worth of profit. Now, with the $600,000 worth of profit, again, like I said earlier, there's three things that I can do with this money. I'm gonna put this in blue. I can save this money in the business bank account in case we hit a pandemic and something happens and now we need cash to help run the company. Or I can use this money to invest it into growth. We can hire more people, we can do more advertising, we can do more things with the company to grow bigger, to go faster. Or I can do essentially a dividend, where now, assuming I'm the whole owner of the company, which I am at the time of me recording, I own the whole company, I can take the $600,000, put this cash in my pocket, and then I can go out and buy a nicer car. I can go out and maybe invest in real estate. I can go out and buy some Gucci or Louis Vuitton. I don't do that, but I could if I wanted to. I can take this cash, put it in my personal bank account, and then I can do whatever I want. There is a cost and benefit to each one of these, not for me personally, but for the company. Because now, if I take the $600,000 of profit out, I put it in my personal bank account, well, then the company is not going to be able to grow as fast as it would have if I took the $600,000 and then I reinvested it back into the company. Because if I take the $600,000, put it back into the company, we go out and do more advertising, we do more marketing, we hire more people, then maybe next year our revenue can grow from $1 million to $2 million because we're taking all of our profits and reinvesting it back into the company. If it grows to $2 million, then the market capitalization would then go to $20 million, assuming that it still has the same valuation. So if you own stock in this company, your stock would double because then we can work to grow the company, even though my profits are smaller. But if I take all this cash and I put it in a dividend, I pay it to myself, well then I don't have the $600,000 in the company to go out and grow the company. Now the company just has to grow in whatever organic fashion that it does. Maybe it only grows to $1.1 million next year, which means that your stock will only grow by 10%, but the owners, in this case me, gets a dividend. It gets cash in my pocket. So this cash in my pocket goes to the owners of the company, but it doesn't help grow the company itself. So it doesn't really help grow the stock price. However, it does help the investors because now you get cash in your pocket. If you're investing the money back in the company, well, that does more for the company, for the share price, because then it makes the valuation more attractive because now the company is working to grow the revenue, is working to grow the profits, and that can help grow the valuation of the company. And then you also have this side, which often gets overlooked, which is saving money in the company. Now, the interesting thing here about saving money is it's not attractive to an investor. Because if a company has $10 million or $100 million on their balance sheet, that's money that's just losing value to inflation. It's not doing anything. It's real valuable when the cash gets put to work. If the cash is used to help invest back into the company, open new stores, hire more people, grow the company, or the cash can become attractive if you use it to go out and buy another company. But generally, to an investor, the saving isn't very good. However, it is good for the company when things go wrong because then this company can be sustainable. We saw the effects of this in the 2020 pandemic because so many companies didn't have the cash to go through 2 rounds of payroll without having to go into debt or without going into bankruptcy. So there's value of savings, but again, the company has to match this balance with how fast do they want to grow the market capitalization of a company. So if there's one concept that you can really get out of this entire video, it's understanding this, that when a company pays out a dividend, you have to understand what that means to the company because that means the company is going to have less cash to grow the company quicker. However, it's still good for the owner, the shareholder, because now you get your cash in your pocket. So it's a little bit of a safer investment for you. However, you can expect your stock price to grow less quickly because less money is going back into the company. That's why many times the companies that pay out these dividends are the ones that are much bigger, the ones that are much more mature, because they just don't have a place to put this cash. They're so big, they're so large that they can't invest all this cash back into their pocket because they just don't have a way to do that. They can't grow that big. So now that's why they're paying out some of this cash to their shareholders as a dividend. So you want to understand that and what this means for your investment, because you have to understand your goal will not be to see the max stock price appreciation, is to get steady cash flow. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.